there is no way around the fact that we've debased our money in the short term to get political advantage, to look popular, and to pay for things we can't afford. In the long term, that's going to be very destructive, and it's going to continue this financial stress, that's going to continue this social unrest, which is going to continue to polarize things. And I don't think Biden or Trump can unify that problem or solve that problem easily, given how divided the country is right now.
Matthew Piepenburg returns to the show. He's a partner of Greyerz AG. We'll be talking about the geopolitical implications of the unfortunate attempted assassination of Donald Trump over the weekend. But the broader theme is what's happening in our current debt crisis cycle. Matthew, welcome back to the show.
It's great to be back, David. Looking forward to talking as usual.
I appreciate you making time for us while you're away. Lots has happened over the weekend, so let's talk about it. I think the broader theme is what's happening around the world in terms of volatility in our society. You mentioned to me when we spoke early in the year at the Vancouver Resource Investment Conference that history repeats itself in the sense that a debt crisis leads to usually a market crisis, which could lead to a currency crisis and inflation, ultimately to social unrest. I think we skipped a few steps there, but what we're seeing right now is the rise in social unrest domestically and perhaps all around the world. Can you comment on what's happening in the broader context?
Yeah, it's an interesting weekend. It's an interesting couple of days. It's an interesting year. That syllogism you just remarked, yeah, I see the social unrest that comes from currency debasement, which comes from high debt. It's been an interesting year for me. I've been in 11 countries already this year. I'm in Spain right now. I've been in Asia. I've been in South America. I've been in South Africa. I've been in Europe. And we obviously saw each other in Vancouver in January. And the mood is polarized pretty much everywhere, certainly in Vancouver, certainly in Washington, D.C., you know as well, in Canada and the U.S. And obviously this most recent headline, I was in Soto Grande, the night that this all went down. I was at a dinner party and everything stopped because of this assassination. But in the larger context of what I'm seeing, and we'll get into it more, this debt crisis does have a monetary crisis. It does have a currency crisis. Inflation is an invisible tax on the poor and the working poor in the middle class. And in the social unrest, the polarization, anyone listening to this in Canada, the United States is familiar with it. There's polarization also in Germany, and there's polarization in France, and there's polarization in Eastern Europe. So again, I'm not making this up. We all kind of know it. But politics is an extension of economics, and military, as Clausewitz says, an extension of failed politics. And we have it in a blender. We've got a financial and monetary and currency crisis globally. We have a debt crisis globally. We have social unrest pretty much globally. It's a very different year for Trump to be elected, probably. And we'll talk about that in 2024 than it was in 2016. We've got recession in Germany and China and the UK. We've got political stress, social stress. It's all in a blender, and it's all tied together. And the implications, regardless of who wins in November, are pretty obvious to me. And we'll get into that. But I think right now, and I'm not trying to be partisan, but what we just saw the other day in Pennsylvania, look, you don't need to be a political pundit to know that the image of Trump fist pumping with blood on his face and the American flag behind him and a blue sky is more iconic in a lot of ways than the flag at Iwo Jima. And I think the contrast to that with poor Biden introducing Zelensky as Putin in a just absolutely failed debate, that combination, Trump is looking at least far more presidential. Again, regardless of your politics, we can all left or right see that. And, with Bill Ackman and how Elon Musk supporting Trump, it's the current in Trump's favor. We have to be honest and realistic about. And typically, historically, when there's an incumbent, they usually win the White House if the markets are up at least an average of 9%. And this year, the U.S. markets are up over 18%. But the obvious elephant in the room, or donkey in the room, with Biden and his performance and what's happening politically in the U.S., we can't ignore it. So we have to think about what a Republican president means and what a Trump presidency could mean for the markets going forward, credit, equities, et cetera. But I think, without trying to be sensational, right now, as it stands as of this day, David, it's looking pretty probable that Trump is going to be pretty hard to beat.
Before we continue with the interview, let me tell you about how your privacy is being breached. Do you know how much of your personal information is on the internet? Data brokers collect and sell your personal data, exposing you to risks like identity theft and harassment. But there is a solution. Today's sponsor, Delete Me, is a service that removes your personal information from hundreds of data broker websites. Using Delete Me is quite simple. Just submit your personal information for removal, and their privacy experts will handle the rest. In 7 days, you'll receive a privacy report showing where your data was found and removed. Delete Me continuously monitors and removes your information all year long. Get 20% off of all US consumer plans with Delete Me by going to joindeleteme.com/David and using the promo code DavidLynn at checkout. You can also scan the QR code on the screen here directly from your phone. Join the thousands who trust Delete Me to keep their data private. Get Delete Me today and start taking control of your online privacy. Because of what happened over the weekend?
Not just that, just the polling and the fiasco and the debate. I think it's hard, even it's hard for anyone. And again, I'm not trying to be disparaging to Democrats or more liberal thinkers in the U.S. or anywhere in the world. I can understand a lot of the frustrations people have with Trump, but Biden, you can't Chris Cuomo this, you can't George Clooney this. The world's seen his decline mentally. The joke was he's a standing example of the 25th Amendment. His mental condition is a problem. Now, there are those who would prefer anything over Trump, including another 4 years of Biden and Harris or whoever comes into the DNC. But I think without trying to be pro-Trump or anti-Biden, and I know that's hard because people will think there's a bias, but I think you can be relatively objective. Even the Democrats are extremely worried about Biden's ability to serve. So we have to think honestly about what a Trump presidency will mean for the markets. I don't think that's a stretch right now.
I mean, regardless of where you stand politically, I think very few people would argue that political violence is not the answer. Some pundits have argued that this may only be the beginning, though, unfortunately. What can the country do? I mean, from the government or the private sector to reduce the threat of more political violence? What is the missing ingredient here?
Look, I've called it the DSA, the Dis-United States of America. And again, that's not being politically biased. Anyone, left or right or center, in the U.S. would agree that we're not the United States. We're not a united country right now. It's very polarizing. It's a consequence of a lot of things. What we can do, I think, is be realistic. I can be Pollyannish and say we can hope for a better united America with better policies, better honesty, better candor on our debt situation, our monetary situation. We can hope for a better leader. Again, whether Biden or Trump wins, half the country is going to be extremely unhappy. And the violence we're seeing, again, we don't know enough about it. There's hardly any reason to get into a conspiracy theory. It's the violence we're seeing is not surprising, though, because there are many who see Trump as Hitler 2.0, or a fascist. And there are many who see just the opposite. They see that in the Biden actions of the DOJ and the weaponization of the media and weaponization of politics and the courts. Again, depending on your bias or your position, you can make a clear case that both parties are guilty of it. But regardless of whatever your view is on politics, and just the fact that we have to caveat this conversation so carefully about who wins in 24 because we're going to upset half the audience is a testament to how divided we are. But again, what can we really do? I think we can prepare for more social unrest because we're going to prepare for more inflation, a more debt-based kind of, not the end of the USA or the end of the empire, but a very difficult USA and a very difficult economic setting in the world. Again, whether I was in Istanbul or South Africa or London or Paris or here in Spain, everyone feels it, rich and poor. Everyone feels the economic stress. What we're seeing in the US right now is the ramifications, the ripple effects of that economic stress affecting political views in a very, very polarized country. And again, in terms of the markets, we can make some predictions right now, and we should. But to answer the question, Dave, what can we do? I don't have an easy answer. And I've joked it, my take is whether we have Papa Smurf, Mother Teresa, or Albert Einstein in the White House, or Donald Trump or Biden, you're not going to be able to ward off the inevitable economic events that are going to happen post 2024, maybe even before the election. I don't think anyone can solve this problem, the debt problems that we have. And we can go into each of those sectors from, equities, credits, the Fed, rates, inflation, currency debasement. This is just, no one can solve this right now. We've passed that Rubicon, but we can certainly make a few minor predictions about what will happen if Trump is in the White House.
Well, let's just talk about market response before we talk about these deeper debt crises issues. So as we're speaking today on July 15th, Monday, the S&P 500 is up slightly. The Nasdaq was up more and came down earlier today. Bitcoin is up 5.5%. It's now at $63,000. It spiked dramatically over the weekend following the news. 10-year yield is up 1%. Gold is slightly unchanged. We'll talk about gold in just a minute. What do you think the market is pricing in right now?
Again, without trying to upset half the audience, I think the
Right.
market is pricing in realistically a very realistic possibility that Trump will take the election in
That is
Florida.
what I've read, but why would a Trump victory be positive for those assets that I just listed
Yeah,
out?
very good question. First, to take Trump out of the equation, just look at a Republican versus a Democratic White House. I mean, traditionally, typically, a Republican White House is more market friendly. And, Biden has openly said, I'm the poorest of the 100 senators because I've never owned a stock or I don't have a stock portfolio. I'm more interested in labor, the middle class. That's the argument. Republicans in general tend to be more market focused. But if you look at Trump in particular, because he is the Republican nominee, and J.D. Vance is now, as like a half hour ago, the vice president, Trump is going to be clearly pro M&A. He's going to be pro stock market. I mean, I think he must have tweeted 100, I think over 150 times during his first term that the market is a barometer for his popularity. And he was always tweeting throughout his administration that the markets are up since my election. And that's some truth to that. I mean, Trump, we can expect from a Trump White House, he's no fan of regulations. So we're going to see financial regs loosen. I think we'll see he's very pro oil and gas. So those restrictions on liquid natural gas exports will probably be removed. He's going to be less restrictive on big tech. He's got the trade wars with China. That's going to be tough globally. He's definitely going to be pro tax cutting. And I think if you look at that, that's kind of future things that we can predict based on what he said and what he's done in the past. And even history, David, I mean, in 2016, when elected, markets kind of went down for about 2 hours and they ripped north. In the first 30 days, the markets were up 5% based on this kind of pro-business Trump mentality. And then despite trade wars and despite impeachments and despite all that, markets saw record highs under the first Trump administration. So I think the markets are pricing in a more market-friendly White House. And, in his first term, we saw higher market rises than we saw even in Obama's first term. So there was an optimism around Trump, whether there's a correlation between Trump and markets rising directly or whether it's Fed policy is a larger debate. But even tech surged over 150% in his term. So if you look at that history under Trump, you could say history repeats itself. I would say it's a very different world in 2024 than 2016. It's a very different debt world. It's a very different rate market right now. We were still at zero interest rate policy in 2016. Now we've got a Fed that's very hawkish. We've got global crises, again, I said in Europe and elsewhere with recession. So it's not the same America. It's not the same rate market. It's not the same debt market. And it's certainly not the same social setting that we saw in 2016. And again, I'm going to say this flippantly. I don't think you could have Papa Smurf in the White House, Santa Claus. You could have anyone in the White House. They can't avoid the realities that we're seeing in the credit markets, the equity markets, the debt markets. And again, it's not a gold bug sensational negativity. I know that's something we have to always apologize for. But again, you can talk to Jeffrey Gundlach. He says we're walking straight into a credit implosion. He is a
Yeah.
bond king for a reason. He looks at these things. You can talk to Jeremy Grantham at GMO, a man I've invested with. He certainly knows equity risks. You can talk to Thomas Hernig, the former Kansas City president of the Fed. He pretty much vetoed everything that was voted there. He was very much the only sole voice of reason at the Fed, but he says we're just one banking crisis away from more QE. And again, that banking crisis, this is from a Fed president in Kansas City, a very honest, good person. That banking crisis is based on over 600 billion in underwater U.S. Treasury collateral and trillions in non-performing loans under this higher for longer policy at the Fed. So again, these are not gold bug sensational things. You can talk to former Fed officials, you can talk to the bond kings, you can talk to equity experts. And I think, again, the banking crisis is another risk. So again, whether Biden or Trump or someone else is in the White House, these problems don't go away longer term. Short term, we're probably going to see markets react positively to a Republican in general and Trump in particular. I think we can expect that. Again, we're still months away from what happens there. We still have a currency crisis. We still have an inflation crisis, and we still have 35 trillion in debt. We've got a CBO, Congressional Budget Office, is promising another 20 trillion in debt in the next 10 years. I mean, we've got global debt at 400 trillion. We've got global M2 up 5x in the last 20 years, diluting the currencies. Our current interest expense on on our treasury is 1.6 trillion a year. That's twice our military budget. Neil Ferguson, Luke Gromen, others have said when you get to that type of distortion where your interest expense is twice your military budget, clearly your wars of or proxy wars or direct or indirect wars have bankrupted your country. So again, very sensational, lots of numbers, lots of data. We can all interpret that data differently, but I interpret that as being to Gundlach's point and Groman's and others, we're walking into not just potentially, we are already in a credit implosion and a debt crisis. And again, not to be disparaging of Trump or Biden, I don't think either one of them can fix it. We're well past that point, David.
Speaking of inflation, this is an article I'm going to bring up for balance sake. The Economist polled at the Wall Street Journal. According to the journal survey, they conducted a survey between July 5th and 9th. They received responses from 68 professional forecasters. 56 of those people surveyed said that inflation would be higher under Trump than Biden, partly due to the fact that Trump has proposed a 10% across the board tariff on imports and another 60% or higher tariff on imports from China. This is inflationary, as we know. Do you agree or disagree with roughly with what's being revealed in this survey?
Look, that's a fair criticism. You can get supply-driven inflation, a supply shock. That's a fair issue. But the real elephant in the room isn't Biden or Trump. I mean, look, every president. Look, you can look at the Obama administration, the Trump administration, the Biden administration. Like they all spend more than they can earn. We all go into fiscal and deficit spending. They're all guilty of that. You can be relatively agnostic. You can talk about supply shocks. So it'll certainly be higher under a Trump "Make America First" kind of. I understand the argument, "Make America First," but the real guilty party, and again, Thomas Hoenig from the Fed would agree, the real guilty party is the Fed to some extent, and any government, any Congress, any Senate that thinks only about, I think, self-interest more than public interest, gets reelected, gets popular on going into more deficit spending. That is a crime guilty on both sides of the aisle, politically or partisan. So to say that we're going to see more inflation because Trump's going to be making America first and raising tariffs and creating supply shocks is legitimate. But the real reason we have inflation is monetary. And the reason the Fed is mouse clicking more money or using the Treasury General Account or the reverse repo markets or supplementary leverage ratios or other things of the BIS to make money looser, liquidity more, backdoor QE. The real reason we have inflation is because we're literally creating the broader money supply to monetize our debts. And as Hoenig would argue, the Fed is guilty of giving the crack or the drugs or the punch bowl or whatever you want to call it to those politicians. But fiscal spending is such a shame and such a sin, Republican or Democrat, that's the reason we have inflation, because our debt to GDP ratio is well over 120%. We can't export inflation the way we used to when we had a stronger kind of dollar or reputation. So all these things are really about both sides of the aisle in Congress, in the Senate, spending more to get reelected in the short term. And I'll pause on this one point. Again, I was listening to Thomas Hoenig made a very good point. When he took the helm of the presidency at the Kansas City Fed, his mentor at the time said, make policies for the long term and let the short term work itself out. The problem is our Congress, our Senate, our White House, whatever the party has, and our Fed has done just the opposite. They've made policy for the short term, kicking the can, monetizing debt, extending debt, and not worrying about the long term. And that's the problem we're in, because we have been long-term blind. I wrote an article about the next generation being screwed, and they are, because we've been in this generation spending more politically than we can bring in tax receipts and GDP. That has created a debt crisis. That has created a crisis of the Fed, because whether they raise or lower rates, inflation will be the end game, even if we have a disinflationary market collapse or recession. And so that is the real problem. All politicians in DC, and I consider the Federal Reserve politicians, they have all created the sin of thinking about re-election or the next 30 minutes or the next 3 years first, and not the next 20 years. It's the opposite of what a good Fed official should do. It's the opposite of what a good politician should do. And I can't say, maybe this will please the audience, left or right, they're all guilty of it. And I think Trump is certainly going to be, if he does win, I don't think he alone can save the debt crisis with words or good intent, no matter how patriotic he is, and I'm sure he is, Biden too. Neither one of them can solve the debt crisis now without talking bluntly about austerity, about cutting entitlements. I mean, we have a $210 trillion deficit and 191 in assets and 210 in liabilities. That is a banana republic balance sheet. We've got real problems that we can't ignore, but we can't just gloss over those with fancy pictures or fancy words or good or bad policies. Again, that's no fun at a cocktail party in Spain or France or New York or DC. I don't see any way around that. We can raise rates or we can cut rates, but we're still going to end up in an inflationary scenario. If we cut rates, which we're going to have to cover our interest expense at some point, that's going to be inflationary. If we stay higher for longer, we're going to have to print more money to monetize that debt. That's the fiscal dominance argument that we've talked about and you've had others talk about. There is no way around the fact that we've debased our money in the short term to get political advantage, to look popular, and to pay for things we can't afford. In the long term, that's going to be very destructive, and it's going to continue this financial stress, that's going to continue this social unrest, which is going to continue to polarize things. And I don't think Biden or Trump can unify that problem or solve that problem easily, given how divided the country is right now.
I don't think it's just you and the gold bug saying that we have a debt problem. The BIS has admitted this themselves recently. This was dated June 30th from Reuters. The Bank of International Settlements warned on Sunday that rising government debt levels amid a number of major elections this year could roil global financial markets. This was from BIS General Manager Augustine Carlstens. He said, with interest rates not about to go back down to ultra low levels and cost pressures from aging populations, climate change, and rebuilding defense capabilities, economic stimulus plans, and a general rise in protectionism, it could unsettle sensitive markets. He said they could surprise you with not much notice, were his words. Well, now that this alarm bell has been raised by the central bank of central banks, what are they going to do about it is my question.
Well, they've already shown you what they're going to do, but they're going to blame it on other things, extraneous events, military budgets, protectionism, environmental issues, social unrest, COVID, all these crises. They're very real and they certainly affect debt, but the real crisis existed long before COVID, long before ESG became the headline du jour, long before this political arrest. We had a debt problem clearly in motion. And we had a debt problem because central banks were supporting whoever was in power to monetize that debt and destroy the currency. The US dollar relatively stronger than others. But the real problem, ironically, is the mother of all central banks of the BIS, including the individual running it. And the real problem is the central bankers who, yes, they may have had pressure to keep monetizing that debt, and you can blame the Congress or the legislator for creating that debt. But the real problem existed long before these quote unquote headlines, long before Ukraine, long before COVID. We saw this in 2019 when the repo market crunched and they didn't trust each other's collaterals among the big banks. We saw the bailouts that the Fed did, backdoor QE. We're seeing that right now with supplementary leverage ratios. I'm not trying to just take away the sins of the central banks, but we've seen a debt crisis before all the headlines that the BIS is now blaming. We saw these problems long before COVID hit the headlines, long before the bank failures of 2023, long before we weaponized the US dollar in 2022 against a major nuclear power already in bed with a major oil importer, and we've sanctioned the world's greatest oil exporter. We created so many shots in our own feet, in our own chest, in our own temple, long before these BIS or Fed apologists can now come up with some excuse. And again, watch what the world is doing, not what they're saying. Watch what they're doing with the dollar. Watch what they're doing with the oil markets. Watch what they're doing to monetize the bond markets. They are desperate, and they're running out of tricks to buy time. And again, I can't predict the Mugs game when it blows, but from Gundlach to Jeremy Grantham to Thomas Hernig, I'm on the same page, to Luke Groman. This is not sustainable. And this is not fixable by anyone, left or right or center, in the White House in November.
Okay, well, the central banks can't just erase the debt overnight, but what they can do is control interest rates. So do you think with this narrative now out in the open in mainstream news, do you think that the central banks are going to be under more pressure to cut rates even faster? Not just the Fed, but I'm talking about the ECB, Bank of Canada, Bank of England. What's going to happen?
Well, they will. They will have to cut rates because they can't afford higher for longer across the board, from Japan to DC, from Tokyo to GC. They can't. They can't afford these higher rates. They can't afford a stronger dollar. But what does that mean? Cutting rates buys time, but it still debases the dollar. It's inflationary inherently. It will ultimately mean that they can solve a problem. Technically, you can have deficits without tears if you monetize every debt. Yeah. But you can even make the S&P immortal, that it could never go down, or every dip can be captured or saved. But you do that, David, at the expense of the currency. And again, this is not just history repeating itself in rhyming. This is how all debt-soaked nations, empires, oligarchies, monarchies, democracies fail. They don't disappear. Their currencies don't disappear, but this is how they fail. And the dollar may fail last, to Brent Johnson's point, but it's failing because The only way, since we're not going to get the productivity and the tax receipts anytime soon to solve this problem, and we're not going to cut military spending, we're not going to cut entitlements and Medicare and Social Security, that's political suicide. The only way to sustain this circus, this magic show, is at the expense of the currency. And again, that's why I became a gold investor instead of a risk asset investor. I have nothing against speculation. I have nothing against the returns you can get on the S&P to fight inflation. I have nothing against looking for risk or going further on that risk branch for yield that doesn't really exist. But yes, it's inflate or die now. And you can mess interest rates, you can play with that, but you can also play with the fiction that we're beating inflation by lying about inflation. I know that sounds sensational, but we are. And the reason they're using PCE instead of CPI is it's a little more rigged, a little more easy to trick, and it's a little bit closer to 2% than the CPI. But all of that we've talked about in the past. The net is very simple. All broke nations debase their currency to stay elected. And whether that's left, right, or center, I don't see any exception around that. And that's why gold is hitting all-time highs. That's why the world is turning away from the US dollar. That's why the petrodollar is not dying, but it's changing. And that's why China is buying oil in yuan, and Russia's converting that into buying goods in China that were once made in America, and then that's settling in gold. And that's why since 2014, central banks in the East are dumping US IOUs and stacking physical gold. You don't have to be a gold bug to see what the world is doing, not what they're saying. And they're using the US dollar as they're really using it as a liquidity asset, but they're using gold as a reserve asset. And the BIS that you just quoted just made physical gold a tier one asset last year. These are not coincidences that the world since 2022 does not trust the US Treasury, does not trust the US dollar as much as it did prior to sanctions. I think if you wanted to destroy America quicker, you would put someone who would make a decision to sanction Russia. That was, I can't believe we did that. Again, pro or left, Biden or anti-Biden, that was such a watershed moment, David, in 2022 in Q1. As big a watershed as the fall of 1971, we got off the gold standard. Again, I'm not alone in this. Fed officials, certainly Grant Williams and others, Luke Gromen, that was so obvious to see that once we did that, trust in the US dollar and the US IOU was going to get even worse, because you don't want a weaponized world reserve currency. You want a neutral reserve currency. And now with Saudi Arabia and the UAE slowly, not overnight, as I said over 2 years ago, slowly moving away from the dollar, slowly catching on that the U.S. Treasury doesn't give what it used to do. The U.S. dollar has lost 98% since we started the petrodollar story. The world is going away to dollar as base money and energy as base money, and they're seeing this oil trade, and they're seeing this net settlement in gold among the BRICS, which membership is rising. All these things are tied together: debt, de-dollarization, currency debasement, politics, social unrest, inflation, currency debasement. This is not a gold bug argument anymore. Look at what the world is doing, not what they're saying.
How do you interpret gold's movement post Sunday? So I was reading a lot of my Twitter posts, reactions to Twitter and whatnot. People were expecting gold to move a little bit higher following the shooting at the Trump rally. It did move a little bit, not as much. Were you surprised that there wasn't more movement here in the gold market?
Again, yes and no. I mean, you could argue gold loves chaos, and we've just seen nothing but chaos for the last few days. And you would think it would go up. And there's others, there's others who would say, look, when there's a crisis, people need liquidity to cover margins, so gold could even sell off a little bit. You look at the ETF outflows in gold and silver. Again, you could make arguments as to why. I look at gold as a long-term play as currency insurance. I've never changed that. Although its optionality as a speculation asset is still there. It's outperformed the S&P since 2000, but you could argue pick your statistical window. But again, the way I look at it, the gold move in the next 10 minutes or the last 3 days isn't as important to me as the next 5 to 10 years. And whether I look at it from currency debasement, whether I look at central bank gold stacking, whether I look at the petrodollar changes, which would take an hour and a half to get into in detail, whether I look at these seismic shifts, whether I look at the exports out of Switzerland into UAE and Saudi Arabia, their biggest export this year where I work out of is gold. These countries are stacking gold because they want to use it as a reserve asset, as a savings asset. They're going to use the US dollar to spend for liquidity. But it's really this seismic shift that we saw in 2022 that even I and Grant Williams said was irrevocable is happening faster than I even expected. And the gold move day to day, hour to hour, week to week, it's an important question if you're speculating in gold. It's not an important question if you're using gold as currency insurance for dying fiat money. And it's not really a concern for any of our clients in 90 countries because they've seen this. They've seen the writing on the wall for years. And again, Egon von Greyerz, my colleague, started buying gold at 300. Everyone laughed at him. Not to say that if you're buying stocks and bonds that you're stupid, if you're speculating, you're stupid. Yes, there's other things you can do. If you're into wealth preservation, gold is so obvious now based on what the world is doing. That hockey puck or polo ball that I say, you go where it's moving, not where it's sitting. It's so clearly the world is moving towards gold as a better reserve tier one asset than an unwanted IOU from the US Treasury. So again, you got to separate the gold bug sensationalism from the simple realpolitik of history and math. The math is what the debt numbers we just talked about are. History confirms every time without exception that currencies, again, go to ancient Rome, go to 1789 France, go to 1999, 1990s Yugoslavia, any time on the history map or any part of the calendar, you will see that currencies are getting debased. And that's why I don't, to answer your question, yeah, gold is going to move significantly higher over the next 5 years. Will it move in a straight line? Absolutely not. Could, but I doubt it. And if there's a sell-off in the markets, gold is very sympathetic for the first 90 days because people need to get liquidity and they sell their gold. But the direction of gold is simple. It's not that gold gets stronger, it's fiat money gets weaker. I'll say it over and over again. And it's getting weaker because those debt numbers and data points that we talked about are getting more and more unsustainable. And I don't see any way that a politician is going to cut entitlements or cut military in the U.S. And so it's only going to get worse.
Treasury Secretary Janet Yellen testified before Congress on July 9th. This is what she said.
The more we have used sanctions, the more countries look for ways to engage in financial transactions that don't involve the dollar.
What's your reaction to this quote?
Well, that's one of the few rare times where Janet Yellen has actually said something I agree with. You know, it's been interesting because Yellen has been more about dollar debasing openly and cutting rates and finding liquidity than Powell has been. And there's a number of reasons, but even, Mohammed El-Erian wrote a letter to the Fed basically saying the same thing. The sanctions is not working. Target inflation at 2% is not working. We have to rethink more clearly the math behind this. It's fascinating that Yellen would agree to that. Why didn't they see that in 2022, in February and March, when they made this decision? And again, we can get into all the pro and con arguments of what Ukraine stands for, what Zelensky stands for, whether that was a good or bad decision. My political views on that are irrelevant. But even if you take an agnostic stance on that, when you weaponize a world reserve currency, you're going to lose trust in that currency. And trust is hard to quantify. Confidence is hard to quantify. Faith is hard to quantify. But again, for Ronnie Sturfula, Grant Williams, Jim Rickers, myself, Lou Groman, that was a watershed moment. And the things that we've seen since 2022 to today, 20% of global oil sales in 2023 outside the US dollar, that would have been unthinkable pre-2019, 2018. These things are happening. It's happening so fast, and we're in history right now, so it's hard to see it when we're in it. I think my grandchildren will read about this period, be scratching their heads, assuming there'll be honest information and honest education, and history isn't canceled. They'll look at this and say, what were they thinking? And will we get a politician like Thomas Hoenig at the Fed who'll speak bluntly, honestly about our fiscal situation, our debt situation, our currency situation, and speak honestly about the moral hazard of thinking in the short term and not the long term and what that's done to our country? And for guys like Bernanke, who won a Nobel Prize, or even Powell, to say that what the Fed does has no real impact on social wealth inequality is absolutely untrue. 90% of the stock market wealth that came post 2008 is in the top 10% of our economic systems. So there's been a massive wealth disparity directly because of Fed policy, because the inflation went into the S&P as well. And so you can't deny that we've made so many mistakes thinking short term to support the markets at the expense of the economy, because the markets and the economy are two very separate things. And Thomas Hoenig reminds that it's the role of a real Fed officer to think about the economy, to think about the long term. What the Fed has done is bail out every dip in the market and every political headache and every fiscal problem from COVID to pre-COVID with money literally mouse clicked out of nowhere. That is inherently destructive to the currency, which is destructive to the purchasing power of the citizens, which is destructive to their political views, their social views. And they're looking for everyone to blame based on gender, based on color, based on social class, based on elite schools or unelite schools. I couldn't imagine anything more silly right now than the division, the tribalism in our country. And it's going to only get worse. Again, Biden or Trump, imagine a scenario where Biden wins. It's possible. What will that do to the base of the Trump support? How will they react? And what will happen if Trump wins? The never Trumpers and the large portion of America who can't imagine Trump, who think of him as the next Mussolini, what's that going to do for our social unrest? What's that going to do for our security? What's that going to do despite all the economic problems? When you add on this invisible tax of inflation, which is completely, as you know from John Williams or even Larry Summers, our inflation number is a classic lie. And when you add on the invisible tax of inflation with regular income tax and the purchasing power of your currency getting weaker and the cost getting higher and the interest rate still too high for too long, you couldn't make up a more perfect storm for social unrest. And so, David, I don't have an easy answer. Like I said, Mother Teresa, Papa Smurf, Santa Claus in the White House, I don't know who's going to fix this. And I do see what politicians do best, and this is what Hemingway warned: distract the world with wars or blame inflation on an extraneous event. But that is always what happens when political opportunists come in and bankrupt the country. They go from temporary prosperity to the permanent ruin of inflation and war. And for the last many years, what have we seen? Inflation and war, direct or proxy. I'm not making this up. The facts say it. And so it's not an optimistic view. And, there are many who are going to be very happy if Trump's elected. I understand that. But again, no matter what you think of Trump's motives or sincerity, I do believe he's a very sincere patriot. I don't disagree with that, but I don't see how he can fix it. And I certainly don't see how Biden can fix it. I think Powell is so trapped. The Fed is so trapped. And Yellen and Powell are basically having mutually exclusive policies that contradict each other. But at some point, we're gonna debase the currency. We're gonna reduce rates to cover our expenses on our debt, and it's just gonna destroy the purchasing power of an already waning U.S. dollar, which is relatively stronger than other currencies. So if I was in Turkey or Argentina, I get it. Fiat versus fiat. I'd rather have dollars than pesos or lira. But the problem is the purchasing power of that king dollar just isn't what it used to be 5 years ago, 5 decades ago, 5 minutes ago. And that's just the sad reality. And that's why gold is something I talk about, because that's why Bitcoin is so popular as well. Again, another anti-fiat middle finger asset class. Not here to disparage Bitcoin. Personally prefer gold, but there's no coincidence that both are doing well in a situation, in a backdrop like we're in socially, financially, economically.
Notable figures in the investment space calling for a civil war include Ray Dalio. The concept of another civil war has been unthinkable up until now. Apparently, his assigned probability of the scenario is now at 40%. He recently wrote a big piece for the Time magazine published online about the coming great conflict, which more or less supports what you're saying, although he takes a different route. He's not saying it's solely due to inflation. There are other factors involved. Generally speaking, how does this affect your investment outlook?
Well, by the way, Ray Dalio, obviously we all respect for a number of reasons. The opposite to civil war would just be what I've always argued is more centralization, less civil liberties. The first 10 amendments to our Constitution, except for the Second Amendment, which is always under threat, are basically being watered down. And the CBDC case, and the centralization case, and the media case, and the censorship case, which Musk has been arguing about, we can't deny that America, and I think Canada as well, feels less free, less open than it did 10 years ago. That centralization is another consequence of a failed, debt-driven, debt-soaked, failed system. In terms of my market outlook, again, and I'll take Luke Groman's point to this, if you continue to provide liquidity and you continue to deregulate certain things and you continue to support an otherwise respirator bond market and otherwise narrow and completely distorted equity markets, you can technically, through modern monetary theory, avoid a market crisis, an investment crisis. You can keep monetizing bonds to keep rates under control, or yields under control. You can theoretically have a market that is nationalized to the extent where you just keep bailing it out with synthetic liquidity, backdoor or direct. But again, even if you get that happy ending for the markets and for bonds and stocks, you're doing it at the expense of the currency that measures your return. If you're getting 18% on the S&P, but inflation keeps eating away at the purchasing power of that 18%, at some point you're literally rolling uphill on roller skates. Remember, inflation is a rate of change. It's not a price level change. If you had 9%, then 6%, then 3.7%, that compounds year after year. So the purchasing power of your dollar, some would argue in the last 10, 5, 6 years has lost 40%. Again, we can get wonky into the math, but we all feel it. Regardless of what the Bureau of Labor Statistics says, we all feel that our $100 bill or a $50 bill or a $20 bill buys a heck of a lot less than it did 20 years ago, 10 years ago, and 5 years ago. And so, yes, you can technically have a positive outlook on the markets if we monetize them. But again, what are you measuring your portfolio returns in? What are you measuring against what inflation hurdle? Regardless of that inflation hurdle or that net return versus gross return, you're still measuring in dollars that buy less. And that is the sin, the hidden sin that no one wants to talk about. And that dollar, which has been, again, has lost 98% since 71 against a milligram of gold, that dollar is getting even weaker as it's being de-dollarized, slowly but surely at a faster pace than I've been predicted. So I can't think of a scenario where, other than its relative strength being better than others, to Brent Johnson's point, and being the last to fail, I still can't see a scenario I'd want to measure my wealth in fiat money. And I'd rather measure it personally in grams and ounces, and many smart folks have done the same. Some would go for Bitcoin. Again, not here to have a debate about Bitcoin versus gold. I think it's important, but I understand why Bitcoin's narrative is so successful, because it's the same narrative as gold in terms of why we own it. And it's because we've lost faith in that currency. And believe me, I've been all these countries this year. Everyone has the same view about the US dollar. And it's not that de-dollarization was plan B, it was plan A. And we fell right into the hands of Russia and China by weaponizing the currency. We've just made these BRICS nations. The mortar between those bricks is getting thicker and thicker, and it's walking away from the US dollar. And the dollar will not die. It'll still be the world reserve currency. It'll still be the king of FX liquidity. It just won't be trusted and used as much. And if there's less demand for the dollar, from petrodollars to net settlement and in BRICS trades, if there's less demand, it gets weaker. So again, that's why gold is an anti-fiat solution. That's why Bitcoin narrative is so popular. Trust in the dollar is changing. Use in the dollar is changing. And the BIS made gold a tier 3 asset. That's not a coincidence. And central banks, I'll say for the gold, are buying more gold than they are buying Bitcoin. And I think there's a reason. And so for me, it's getting to the point where I have almost too much confidence in gold, because I've lost so much confidence in the politics, so much confidence. I've lost so much confidence in the media. I've lost so much confidence in the Fed, including other people like Thomas Hernick, who are Fed officials. They are equally as cynical as I am. So it's not a gold bug argument anymore. Look at what the world, the smart contrarians who aren't emotional and who are based on facts are saying, and look what they're doing. And I think you can draw these conclusions on your own. Look at the facts, make your own opinions. I look at these facts and I can't think of a case where gold doesn't get higher and stronger for longer. And again, I'm almost worried I'm too confident about it. And sadly, as Egon and I have been saying for years, be careful when gold starts hitting new highs. Be careful when central banks start stacking gold. Be careful when the BIS calls it a tier 1 asset, because that means the rest of the world is going into deeper and deeper trauma, deeper and deeper difficulties, deeper and deeper social unrest, and more centralization. All those things are happening. Again, left or right, we can't deny that these things are happening. And to Trump's supporters, we can't deny that the media has abandoned itself, that the Fourth Estate has not been true to itself, that it has not allowed for open debate, that there's been obvious censorship. We can't deny the weaponization of the DOJ. We can't deny the warfare or lawfare things that we've seen in the last 2 or 3 years. We can't deny how polarized this country is. And we can't deny how in debt we are and how debased our currency is and how sticky inflation is. I just don't know how else to say it.
Okay, makes sense. Are you still risk on? We spoke a couple times this year. In January, I remember you told me that despite the risks posed by the debt crisis, the ballooning debt, you still have a more risk on sentiment for the remainder of the year. Is that still the case?
Well, it was. I mean, what did we say in January? And again, it was. I said
that call turned out to be more or less correct, by the way, because the stock market has done well. Gold has done well as well, but all risk assets have done quite well so far. I'm just wondering if your sentiment has changed.
It's a bipolar answer. As I said in January, the Fed didn't even have to cut rates. Remember, we were talking in Vancouver; they were talking 6, and the dot point charts, maybe 3 cuts.
Yeah,
I think they'll come in September, but. Think about it. It didn't even require an actual rate cut. Powell, being the clever man that he is, just had to use the word rate cut. He just had to suggest a rate cut, and the markets went galvanic and giddy like Pavlov's dogs. Just the carrot of a potential rate cut in 2024 sent markets ripping. We haven't even had a rate cut yet. I think the actual event of a rate cut will also be bullish for risk assets, despite how completely narrow and overvalued this S&P. Yes, I've been risk on since January. I was risk on when the Fed did unlimited QE in March of 2020. When they give you a fat pitch, you got to swing. But the other the flip side to that optimism, and by the way, I think a Trump election could be temporarily very bullish. I think a rate cut will be temporary, very bullish. What you have to keep in mind if you're speculating right now is the forces of mean reversion. And that's why guys like the singers at Elliott or like Ray Dalio or Jeremy Grantham are very concerned because these spikes on promised rate cuts or potential rate cuts on a narrow S&P and a narrow NASDAQ, the percentage of market cap, I would argue that the S&P is effectively a tech ETF. I saw this movie before in 1999 and 2000. It's a very scary time to be trying to time this market's uh-oh moment and trying to time mean reversion. Yes, there's risk on symbols everywhere and signals everywhere. And I've been risk on. I was risk on in March of 2020, not because of the fundamentals, but because of the trend of the Fed is your friend now. They're promising rate cuts, or they're going to give you rate cuts. And you can pick up dimes, nickels, and even $20 bills in front of that train. But at some point, I do believe mean reversion will crush this market. I do believe that unless we effectively nationalize the S&P and the NASDAQ and the risk asset markets by yield curve controls and QE to the moon like we saw in the COVID crisis, and we effectively make the S&P, the NASDAQ, and the U.S. Treasury market a national security interest, and we just debase the hell out of our currency to support these markets so that we get better tax receipts. That's the only risk. That I think mean reversion is the most misunderstood and ignored market force in the history of markets. And if we do have a mean reversion, this is what Jeremy Grantham is talking about. You're looking at a Dow and an S&P and a NASDAQ. It's significantly lower lows than their historical lows. And that is what scares me. So you have to take some risk. But if you're going to try and time that inflection point, markets fall much faster than they rise. And that's the doom and gloom, hug your knees thing that I still am concerned about. Like I have been risk on it. And yet it's been with, again, with people who can look at signals, but I think it's very simple. The markets, the S&P and the NASDAQ, it's not a date. It's when net income margins go from north to south. When not earnings, when profits consistently go lower from NVIDIA to Lucent to Microsoft, when that happens, it's game over unless we completely go crazy with QE to the moon. That's it. And so if that's game over, and that's the best story that America has, is it's ripping markets. And when they're led by a handful of names, they're currently very good companies, just overvalued companies. If they lose those net income margins, if their profits go from north to south, then what narrative do we have left? What's left? What's going to hold us? Is it manufacturing? Is it banking? Is it jobs? Is it our bond market? Is it our illiquid private credit pools, which are weapons of mass destruction, which every family office I know is doing right now? Those are worse than the subprime mortgage-backed securities. And yet that's where the smart money's going. So yeah, bullish, David, but incredibly cautiously bullish because, again, this mean reversion and even the bullish returns you're getting on the S&P in dollar terms after the inflation hurdle and after the purchasing power reality of it, you're really running uphill in roller skates. I'm sorry. It's scary.
There's plenty to unpack there, what you just told us in the last 45 minutes or so. But I really do appreciate you breaking down the current chaos for us investors, economists, and people just interested in knowing what's going on. So tell us where we can learn more from you and your work.
Yeah, obviously, we're now Von Greyerz. We were Matterhorn Asset Management for decades. Is an homage to our founding partner, Ian Von Greyerz. We just decided to change the name in honor of his integrity, his views, and his iconic role in this space. But at vongreyerz.gold or still at goldswitzerland.com, our website is there. All our articles and interviews, including guest interviews or guest articles from our advisor Ronnie Sturfula, very smart in the gold space, very smart in the alternative investment space, and certainly in the credit space. So it's all there. You can read us there, and our interviews are posted there as well. And then in addition to just all the arguments for why gold and looking at risk assets, there's a very important part of the website. It's just how to understand how to invest in gold, how not to invest in gold, what jurisdictions, the difference between ETF, paper gold, and physical gold, et cetera. So it's a free education, regardless of whether you come to Von Greyerz or not. There's a lot of data there on gold. Clearly, David, we have a bias. Clearly, I have a bias. Always got to say that, but it's a conviction. And, I'm worried. I'm so conviction friendly now on gold. It concerns me. It really does. I can't think of a case where gold in the long run just doesn't get the last laugh. I just can't.
Bias is one thing. Track record is another. And your calls for the markets have been correct so far this year. So we appreciate you coming on the show. Thank you very much. We'll speak again soon. Take care.
Good seeing you. Cheers.
Thank you for watching. Don't forget to like and subscribe.